AbbVie is trading at $226.49 right now, showing a significant drop of nearly 3% during today's session. This sharp move lower is catching many income-focused investors by surprise, especially considering the stock has been a relative pillar of stability for those using individual brokerage accounts to build long-term wealth. While the broader market might be showing some resilience, AbbVie is feeling the weight of a fresh analyst downgrade and the cooling of some very hot acquisition rumors that had previously propped up the price. If you were looking at your Fidelity mobile app this morning and saw that sea of red, you might be wondering if the long-term thesis is finally starting to crack under the pressure of the post-Humira world. The tension we are seeing today is the classic battle between market expectations and a very cold reality. For years, the expectation was that AbbVie would perfectly bridge the gap between its legacy blockbuster drugs and its new immunology juggernauts. Investors on platforms like Interactive Brokers and Robinhood have been betting on the idea that Skyrizi and Rinvoq would not just replace Humira, but actually grow the pie. The reality, however, is that the market is becoming hypersensitive to any sign that the growth might already be fully priced in. Today's downgrade from Wolfe Research, moving the stock from outperform to peer perform, is a direct challenge to the idea that there is easy money left on the table here. The analyst essentially argued that the recent outperformance of the immunology products is already reflected in the current valuation, leaving little room for error as we move deeper into 2026. This is where the story gets really interesting for anyone involved in online investing. Just yesterday, there was a whirlwind of speculation that AbbVie was in advanced talks to acquire Revolution Medicines. That news caused a massive spike in sentiment, as traders love a big M&A catalyst to drive a breakout. But the company came out and explicitly denied those reports, stating they are not in talks with the oncology-focused biotech. This creates a psychological vacuum in the stock price. When a major catalyst like a potential acquisition is dangled in front of the market and then snatched away, the resulting drop is often deeper than the original gain. It leaves investors on their trading platforms wondering what the actual growth strategy is if these big-ticket moves aren't on the immediate horizon. When you look at the recent stock movement, we are seeing a clear struggle to maintain the momentum that carried the stock through late 2025. Institutional activity has been a mixed bag, with some large funds like CX Institutional actually increasing their stakes recently, while others are taking profits after the stock hit its 52-week highs near $245. The trading volume today is noticeably higher than the daily average, suggesting that this isn't just a quiet drift lower, but a coordinated exit by some participants who are reallocating toward other pharma giants like Merck, which actually caught an upgrade today. This rotation is a key part of the current market cycle. Investors are looking for the best relative value, and when one giant like AbbVie shows even a hint of exhaustion, the capital flows toward the next perceived winner. If you are managing your own portfolio through Schwab Intelligent Portfolios or similar online investment tools, you know that healthcare is often viewed as a defensive sector. However, AbbVie operates with a level of concentration that makes it more volatile than a standard diversified conglomerate. They have bet the house on their ability to dominate the immunology space. The expectation was that by 2026, the Humira cliff would be a distant memory. The reality is that while the revenue hit was managed brilliantly, the competition is getting fiercer. Biosimilars aren't just existing, they're becoming more aggressive in their pricing strategies. This forces AbbVie to spend more on marketing and rebates to maintain its preferred status on insurance formularies, which eventually eats into the net margins that investors have come to expect. Let's talk about the actual business for a second, because the numbers behind the ticker are what should drive your self-investing decisions. AbbVie's core strength lies in its ability to take a massive cash cow and use it to fund a massive pipeline. They are essentially a drug discovery and marketing machine. Skyrizi and Rinvoq are the new stars, and they have been hitting their targets. In the most recent reports, we saw Skyrizi sales growing by more than 40%, which is an incredible feat for a drug that is already doing billions in revenue. This is the reality that long-term bulls point to when the stock gets hit. They argue that the market is overreacting to short-term analyst notes and ignoring the fundamental power of this new duo. However, the skepticism remains centered on the rest of the portfolio. The aesthetics segment, which includes Botox, has been a bit of a wild card. In a high-interest rate environment where consumers are feeling the pinch, elective procedures can sometimes take a back seat. While Botox has a very loyal following, it isn't completely immune to macroeconomic pressures. Then you have the neuroscience segment, which AbbVie has been aggressively expanding through acquisitions like Cerevel. This is a high-risk, high-reward play. If they can find the next major treatment for Parkinson's or schizophrenia, the stock will see a massive re-rating. But until those drugs clear the final regulatory hurdles, the market treats them as a cost center rather than a profit center. Comment below how many shares of AbbVie stock you currently hold in your portfolio, and if you plan on adding more at these levels. It is always helpful to see how the community is feeling when a major blue-chip stock takes a hit like this. Looking at the broader financial picture, AbbVie remains a cash flow machine. Their dividend yield is currently sitting around 3%, and they recently raised the quarterly payout to $1.73 per share. For those focusing on investment help and looking for consistent income, this is usually a strong signal. A company doesn't raise its dividend unless the board is confident in the long-term cash generation capabilities. But there is a catch. The payout ratio has been elevated due to the accounting charges related to their recent string of acquisitions. This doesn't mean the dividend is in danger, but it does mean that the pace of future increases might slow if they continue to spend billions on tuck-in acquisitions to shore up their oncology and neuroscience pipelines. The comparison with its peers is also telling. While AbbVie is dealing with a downgrade, companies like Eli Lilly have been the darlings of the sector due to the weight loss drug craze. AbbVie has tried to enter this space through smaller licensing deals, but they are clearly behind a curve here. This puts them in a position where they have to prove they can win in their own backyard of immunology and oncology without the massive tailwind of a miracle weight loss drug. This is why the institutional sellers might be moving money toward Merck or other names that have a more diversified or currently trending catalyst. When you use investing sites to compare these companies, you can see that AbbVie's forward price-to-earnings ratio is actually quite reasonable compared to the high flyers, but the market is demanding more than just reasonable right now. It wants clear, unobstructed growth. The technical setup for AbbVie stock is reaching a critical point. After today's drop, we're looking at some key support levels. If the stock can't hold the $225 range, we might see a further slide toward the 200-day moving average, which is currently trending lower. For traders on the Robinhood app or the SoFi trading platform, these technical levels often dictate the short-term sentiment. A break below a major moving average can trigger a wave of algorithmic selling that feeds on itself. Conversely, if the buyers step in here, recognizing the value in that 3% dividend and the growth of Skyrizi, we could see a quick bounce back toward the $235 level. As we look toward the fourth quarter earnings report coming up in early February, the expectation is that management will provide a very optimistic outlook for 2026. They need to convince the street that the Humira erosion has truly stabilized and that the new products have the legs to carry the growth narrative for the next 5 years. The reality will be found in the guidance for profit margins. If they have to spend too much to keep their market share, the earnings per share might disappoint disappoint even if the top-line revenue looks good. This is the fine line that pharmaceutical giants have to walk. It isn't just about selling more drugs, it's about selling them profitably in a world where governments are increasingly looking to cap drug prices. For those using interactive brokers or Fidelity wealth management services, the focus is likely on the long-term compounding. AbbVie has a history of outperforming the broader market over long periods, but it is rarely a straight line up. These periods of consolidation and analyst skepticism are usually where the best entry points are found for those who believe in the underlying science. The company's focus on specialty areas like immunology and oncology gives them a moat, but that moat is constantly being challenged by new innovations from smaller biotech firms. This is why their M&A strategy is so critical. They need to keep buying the next generation of treatments before they become competitors. The recent denial of the Revolution Medicines talk suggests that AbbVie might be looking at other targets, or perhaps focusing on integrating the $20 billion worth of deals they've already signed over the last couple of years. Integrating a large acquisition is never easy, and the market often wants to see proof of synergy before it gives credit for the deal. If they can show that the